Hello and welcome to this week's Video Insight. The equity markets posted extraordinary gains across 2023 and 2024, and now, just past the first half of 25, the S&P 500 has done it again, breaking new records thanks to mega cap technology and AI companies, which in turn are benefiting from trillions of dollars in liquidity that's being supplied to the financial system by global central banks. Yet, the question looms, are we witnessing a sustainable boom or an emerging bubble? Or is it a signal for alarm? The S&P 500's ascent in 25 reflects cooling inflation, robust corporate earnings and optimistic guidance. Liquidity is also accelerating at an estimated pace of $10 trillion annually, a tide that lifts all asset prices, especially equities. Meanwhile, about 70% of S&P 500 companies have reported their second quarter 25 earnings as of Tuesday evening, and in a word, their results have been robust. Companies like Nvidia, with tangible earnings, double-digit growth and a forward PE below 40, have been central to this rally. Microsoft's recent earnings report exemplifies the strength. Revenue reached $76.4 billion, up 18% year on year, surpassing estimates by $2.6 billion. Its cloud division, Azure, grew 39%, and Microsoft Cloud now accounts for 61% of revenue, up 4% from last year. Unlike the dot-com bubble of 1999, where pre-revenue startups dominated, today's leaders are grounded in substantial profits. Unsurprisingly, Meta is up 28% year to date, Nvidia 30%, Microsoft 25%, and Dural is up nearly 100%, and military stocks are up 20 to 40%. Despite this strength, caution is warranted. Market volatility has been unusually subdued, and the tranquility feels misaligned with significant uncertainties, which include US President Trump's tariff reintroductions and the historically volatile August to October period. Speculative exuberance is also evident. Short-dated options trading is surging, penny stock volumes have doubled, and profitless meme stocks have spiked 80%, sometimes over just a day or two. Unprofitable Russell 3000 stocks have tripled in value. Leveraged ETF assets have climbed to US $135 billion, and some companies are pivoting to Bitcoin, echoing past market frenzies. Elsewhere, valuations are increasingly stretched. The S&P 500 trades at 22 times forward earnings, and that compares to a historical average of 18. And it has an earnings yield of 4.5%, which is near a two-decade low relative to real yields. The US fiscal situation adds further concern, with national debt eventually approaching $37 trillion. The cost of servicing this debt is ballooning, as bonds issued at 0.25% in 2009 or 2020 are being reissued at 4.25%. A 400 basis point increase that's going to strain the budget. The yield curve is also steepening, even as the Federal Reserve began cutting rates in September last year. The divergence from historical patterns suggests some unease about US debt sustainability. In fact, some commentators are suggesting it reflects long-term US Treasuries that are losing their status as a safe haven asset, and gold gaining favour. In light of these risks, thinking strategically is essential. Diversification across markets and asset classes with less exposure to public equities is a prudent step. Consider rebalancing portfolios, for example, reallocating some of the gains from the highest flying equities to more stable asset classes with less public market risk. This isn't a call to abandon equities, but a reminder to act thoughtfully amid the stretched valuations and emerging exuberance within a portfolio. Well, that's all we have time for. Thanks for joining us, and be sure to follow us on Facebook and X. Until next time.